Hey everyone, we got some massive news for super microcomputer stock investors. Unfortunately, it was news that sent the stock price down. So in this video, I'm going to review what that latest news was, why it caused the stock price to fall, and whether or not this is a buying opportunity for super microcomputer stock investors. So without further ado, let's jump right into this latest news.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the news that came out was that Supermicro is announcing a private offering of $1.5 billion in convertible senior notes that are going to be due in 2029. So this announcement gives 1.5 billion of convertible notes, and it gives the purchaser a 13-day option to purchase an additional 225 million in aggregate principal amounts of convertible notes. So if you're not aware of what convertible notes are, they're a mix of a debt and equity offering. It could be debt, but the owners of that debt, the lenders, have the option to convert that principal amount into shares of stock. Why would they convert into shares of stock? Well, if the stock price increases so much between now and 2029, or the date that they final have to give that answer as to whether or not they're going to convert or not, if the stock price is much, much higher, they'll convert to stock. If it's not, then they'll say, okay, just pay us cash instead. So the convertible notes have an initial conversion rate of 0.7455 shares of the company's common stock per $1,000 of principal amount of convertible notes, which is equivalent to an initial conversion price of about $1,341 per share of the company's common stock, representing an initial conversion premium of about 37.5% above the company's closing price of $975 per share on February 22. So if the stock price between now and that date increases by more than 37.5%, or it results in a $1,341 share price, anything above that, the lender will choose to convert because that means they're getting more than just taking the payment in cash. If it is exceeding that amount, they'll take their payment in shares and they'll make the difference from that amount. So if the share price ends up right at $1,341 per share, then it will be a wash. It will be as if the lender is indifferent between choosing one or the other. It ends up being equal on this deal. So this debt offering is a sort of give and take between the lender and Supermicro. It gives the lender some guarantees in lending this money, in that it's a loan. It can be a loan, so they get their principal amount paid back. It also gives them some upside. If the stock price soars again, as it has so far in 2024, the lenders get to participate in the upside. So Supermicro is giving up some of the upside while retaining some of the downside. It's a sort of mix between having a complete stock sale or having a complete borrowing transaction. So it's a mix in between. So these convertible notes will be redeemable in whole or in part for cash at the company's option at any time from time to time on or after March 1st, 2027, or before the 20th trading day immediately before the maturity date. So, but only if the last reported share price of the company's common stock exceeds 130% of the conversion price for the specified time period. And we're going to see throughout the rest of this video, and as I share with you more of the details, there is some covenants and protections in place here, both for Supermicro and for the lender. Supermicro didn't give up all of the upside. It retained some of that by entering into what's known as a capped call transaction. We're going to see that as well. So it's a really interesting and complex financial transaction that Supermicro entered into here. It's a sort of mix here. Interesting. Um, I'm curious as to why they chose this, given that their stock price has increased by so much in 2024. I'm curious why they chose to do a convertible offering and not just a straight stock sale. But it is interesting. It is interesting. So let's continue here. So holders of the convertible notes will have the right to require the company to repurchase all or a portion of their convertible notes upon the occurrence of a fundamental change, as this defined in the indenture governing the convertible notes, at a cash repurchase price of 100% of the principal notes and any accrued interest. So I won't get into the details of the indenture. We're getting already pretty into some pretty complex financial topics here, and I don't want to get too wonky. This isn't my, graduate level finance course at university, so I'm not going to get into all those details here. But what I will touch upon is that the lenders sometimes put in covenants, indentures inside of the agreement, where if the company's position changes, then that company will pay the borrower, right? So if Supermicro Computer has a significant change in their prospects, and those are defined in the governing agreement, then the lender retains the right to require the payment, right? If they feel that their money is at risk, if they feel like Supermicro Computer might be going in the wrong direction, they could say, okay, we want our payment now. We don't like the direction your company is going. We feel like our money is not safe with you anymore, and we just want you to pay us back our money now. So they've placed that into the agreement where they have that option. Additionally, as I mentioned, in connection with the pricing of the convertible notes, the company entered into a privately negotiated capped call transaction. Those of you that are interested in options trading, here's one of those capped call transactions where the initial purchaser and the affiliates. So this capped call transaction is generally to reduce the potential dilution to the company's common stock upon the conversion of convertible notes is required to make in excess of the principal amount. The cap price is at $19.51 per share. So roughly about 100% of where the company's stock price is at today. So it's giving up, in essence, the totality of this transaction. Supermicro Computer is giving up approximately 100%, roughly 100% of its upside in the share price to the lender in this transaction. So the lender can convert into shares, but if those shares are up more than 100%, then Supermicro Computer gets to benefit from this capped call transaction. So it limits the upside that Supermicro Computer is giving up. All right, so now that we've gone through the details of the transaction, let's understand why Supermicro Computer is doing this. Well, to start with, the stock price in the last 3 months is up 204%. So the company could be just capitalizing on this rapid increase in stock price and saying, well, let's give up some equity now that our stock price has absolutely exploded. Let's take some money off the table. Let's take some of our winnings off the table. That could be one thought behind management doing this. Another is that they need the money. They need the money, despite how well Supermicro Computer did in the most recent quarter with revenue increasing by 103%. They're growing so quickly that cash is going to be a concern. In its most recent quarter, they were negative $595 million in cash flow from operations. Negative, right? And they only have $725 million prior to this update. They only had $725 million in cash on hand. So they're constrained as to their growth prospects because they sell mostly hardware. And when you're dealing with these types of sales, sometimes your cash conversion cycle could be off kilter, meaning you have to pay your suppliers first before you can get your money from your customers. And there's a delay, a gap between the money that you spend to create the inventory and sell the service, sell the product, and when you receive the money, especially for companies that are growing as quickly as Supermicro Computer. So cash was a concern now that they're growing this quickly, and this growth is expected to continue for at least the next few quarters. So they need some cash so that they can fulfill this growth, so that they can support this growth. Not because they're losing money, but because they're growing so quickly. They need to increase the amount they're spending on inventory. They need to increase the amount of working capital so that they can support the growth. And this, more than $1 billion in cash is certainly going to help them. Okay. Now, all that being said, after this news came out, the stock price is down 11% on the day. Okay. So is that a buying opportunity? Well, when I look at the valuation, Supermicro Computer stock is trading at a forward price to earnings of roughly 30, which is near the most expensive it has traded for, in a while. And that's understandable given its prospects have improved so much. But I wouldn't call this a buying opportunity. I wouldn't say this is let's get out and let's get this stock. This might be the last opportunity. I wouldn't say that because the valuation is already rich. It's already so expensive that even this 11% decline doesn't make this stock a huge bargain. I still have Supermicro Computer stock rated as a buy, but it's approaching the borderline where I might tell investors where it's time to take profits from this stock. It's right on that borderline where it's like, it's not that cheap anymore and it's not that attractive because it's gotten so expensive. So for that reason, even this 11% decline, I wouldn't say it's a buying opportunity. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.